if you've ever bought a house and you've gone through that process, you know that you're signing away your life. You're signing so many documents and you don't know what is what, let's be honest. So, one of the most important documents that you're going to sign is a closing disclosure. And I wanted to just take a little bit of time here to walk you through that disclosure and what it means in normal people talk. So, I'm Joe Soto, Cross Country Mortgage, your favorite loan guy. If you like this information, be sure to subscribe. But we're going to get right into it, get right into the document. So I'm going to start here, share my screen, and walk you through an actual closing form. So this is a closing disclosure. And what you're going to notice, and we'll go through different sections here for you, right? You can see sales price here. You can see the loan amount, the interest rate, as well as the monthly principal and interest payment, right? So over here, it says, can this amount change after closing? You want to be aware of this to make sure you don't have an adjustable loan, right? If you do have an adjustable loan, you would see the adjustable periods in here, but you can see interest rate, you could see principal and interest. That's the mortgage payment, right? Not including taxes and insurance. Down here, it's saying, does this loan have a prepayment penalty? It does not. Does it have a balloon? A balloon is where the loan is fixed for a certain period of time and then the whole amount is due. That's called the balloon note. So a balloon would mean you'd have a 30-year loan with a 7-year balloon, meaning it's amortized for 30, but it's due in 7 years. So this is there's no balloon. It's just a standard 30-year loan. Okay. As you come down here, it shows you the mortgage payment. So projected payment. This is the principal and interest. This is the taxes and the insurance. And the total monthly payment is $6,098, right? Down in this section here, it gives you an estimated taxes, insurance, and assessments. So this is showing 1478. So here's one of the first discrepancies you'll see. You see here escrow, you see here assessments, right? This is higher because this actually includes homeowners association dues, right? And it's telling you that yes, this property is homeowners association, but it is not included in the escrow, meaning in the monthly payment. So this in here is the taxes and insurance. If you had mortgage insurance, it would be in there. That's in the monthly payment. The HOA is always paid separately. Okay. So that gives you all of that. So that's one discrepancy you'll see. A lot of people will think that this number needs to be added to this number or this gets added to this. It doesn't. This is the mortgage payment. This is giving you a breakdown that's showing you if you have the taxes and insurance included in the payment, that's in escrow, and the HOA is never in escrow. So easy stuff for you right there. Here we'll run into this closing cost breakdown. So this is part of the stuff that scares people a lot of times, right? When you look at the closing cost, $22,536, that includes lender costs of $13,871. It includes $8,000 in other costs, minus $30.50 in lender credits. And then on the second page, we're going to break that all down for you. Then it's cash to close. Cash to close is down payment, closing costs, prepaids. It's everything that you need to close on a deal. So that is going to be broken down on the next pages as well. And we'll go through all of that right here. Okay. If you have questions on any of this stuff, you can be sure to send me a message or send me an email, Joe at the Soto Team. I'd be more than happy to answer any of these things for you at any time, or you can call me 714-820-1535. I'd be happy to look at any of this stuff for you. If you have an estimate you want us to review, let us know. We can do that for you too. So in here, it's loan costs, right? And so I'll make this smaller. Right here's how the document looks all together. It's overwhelming when you start to look at this stuff, right? But let's go through box by box. Loan costs is all the lender fees. So you can see in here, this loan, had a 0.83 amount of points that was paid for up front. That is discount points that were paid. $63.49. That was for that rate at 6.99. Then there's processing fees and underwriting fees. These fees can vary from lender to lender, right? The amount of the points can vary depending on the interest rates. You could either pay points or you may want to get a lender credit to offset your closing costs. You have those two different options when it comes to costs, right? Up here in box A. Box B, it shows services you did not shop for. This is stuff usually that the lender orders, right? It's it's the appraisal. Lender gets a credit report. Lender's going to get a flood cert in most cases. Make sure your property is not in a flood zone. That's a FEMA requirement. You'll notice in here on the appraisal that it shows paid at closing or paid before closing. So this is, yes, they did have a fee for that appraisal, but they paid for it upfront. Borrower paid before closing. Okay. Cool. Then when you come down here, this says services you did shop for. So it's a little bit skewed because in most states, the seller picks the closing agent or the escrow company. Some states that have attorneys, the buyer can pick their own attorney, right? So this here showing California escrow company, it shows items the borrower did shop for 99% of the time. The seller picks the escrow company. Okay. So this is all of your title and escrow fees, everything in here. Okay. And you'll see, again, there's borrower paid, there's seller paid, because the seller also has a closing fee, right? There's certain fees that the seller has, but we're looking at this just from the buyer's perspective initially. So you have in here courier fee. This is to courier any documents, typically back to the lender, or it's going to go courier back to the to the county recorder. So any documents that get sent there. Document storage fee. This is what they're going to do to store the documents that they charge for that. E-recording fee, it's to record your documents electronically. Lender's title insurance. So title insurance is required by the lender to make sure there's no liens or judgments on the house. That's $11.71. Loan tie-in fee is usually a fee by the title company to tie the loan to the deed here that we see here in California. So that's a loan tie-in fee. Overnight fees is just to send documents usually back to the lender overnight. Settlement agent fee, that's the fee for the escrow company, and escrow is that third party that manages all the money. They make sure everybody gets paid accurately for the escrow, right? That's escrow's job, the settlement agent. Agent signing fee is a notary fee, so that's $250. Sub escrow fee is a sub fee that escrow charges. It's usually $100 to $150, somewhere in that range. And that's to, again, the title company that's paid for to California Title. Title endorsement is to endorse the title, $100. And wire fee, usually they have a fee if they're sending out the wire or receiving a wire. Usually this is for sending the wire for final funds. So here you have a subtotal, all total costs. This is all loan costs as far as loan boxes A, B, and C, right? This is adding up A, B, and C. So if you add up 943 plus the 4589 plus the 817 gives you a total right here, right? Oh, sorry. No, 8339, 943, 4589. Sorry, guys. Gives you the total here, 13,871. So that gives you that total there, but obviously some of it was paid outside of closing. So that's why you have 13,186. Cool. And then down here, you're going to get to other costs. And this is a part that really confuses a lot of people. Okay. So in here, you have recording fees. Every county that you have to record a document with, they charge a fee. Boom, there you go. This county has a transfer taxes. So transfer taxes you have to be careful of because some areas the buyer pays for it, some areas the seller pays for it. So here, this was San Diego County. Seller pays for it. That's why it's over here in the seller category. Oops, seller pays. So that is that in there. And then in here, these boxes really confuse a lot of people, right? So this is prepaids and this is escrow. So when you buy a house, you're going to close on whatever date, right? This was a April closing. So at the closing, the borrower or anybody is going to have to pay the first year of closing of insurance. Sorry, first year of insurance is going to be paid at closing. In this particular thing, the client's insurance policy was 1111, right? Then you're also at closing going to have to pay interest. So this loan closed on the 10th, right? They're going to have to pay interest from April 11th to May 1st. Okay. And then the April closing, no payment in May, first payments in June, but you have to pay interest for the month that you close in. A lot of people don't realize this. So that is right here. That's the interest for the month that you close in. So those are prepaying interest, prepaying insurance. Okay. Down here in box G is where it gets confusing again, because now this is to set up your escrow account, right? This is to set up your account for your future taxes and insurance, also known as an impound account, depending on where you live. So here we're showing that in addition to this 1100 that you've paid, you're also going to fund your impound account with 3-month cushion for insurance, 5-month cushion for taxes. So that's money that's set aside in your impound account to prepay property taxes and insurance, right? Down here, you see an aggregate adjustment because, again, escrow's job is to prorate everything. So the taxes, for example, get prorated because some of this may have been paid by the seller. That's escrow's job to make sure you don't overpay and pay their taxes, right? You don't want to do that. So that's everything that you see there, but it is a little bit confusing. You are double paying. You are ahead in the game, but don't worry, it's normal. Everybody's like that. Now, if you don't have an impound account, if you don't impound your taxes and insurance, you would not see anything here in this box, but you would still see stuff in this box. Okay. Whoops. All of this other stuff, all different things. You can see most of it is paid to the seller, right? The seller paid by the seller. The part that's due to the buyer is homeowner's dues. So this particular property had an HOA. They're collecting the first month of HOA at closing, and that is collected right there. So you see that if you have an HOA, know that that's going to be part of your settlement. So that's going to be right in there. And then you have the totals, right? So down here, you could see it adds up boxes E, F, G, H. That's a total of 86.95. And then down here, you have the total of everything, which would be both sides, which is D and I, right? Which is the first top part and this part, I and D gives you that total of 22,536. Okay. So that's everything in there. So that you see that. This $30 credit was what we call a tolerance variation. So as a lender, if you disclose a fee, let's say 630, 700, it can't go up by a certain amount. If it does, the lender has to cover it. So that's why we didn't disclose the right amount. We credited back the $30.50 is what is in there. And then this last page, we're going to go through. So this is calculating cash to close. Again, it gets a little bit convoluted, right? Because you can see what was sent to the client on the loan estimate. So a loan estimate is a different document. That's a document that you get when you open escrow and you have your initial fees. And so you can see, on the loan estimate, we had estimated the total closing cost at 27,000. The real numbers was 22,536. We didn't have them paying, the appraisal beforehand, but yes, they did pay the appraisal beforehand. This was the down payment they had agreed upon. This was the deposit. In escrow, seller decided to give our client a $5,000 credit. So there's an adjustment there. You could see an adjustment of 2377. And oh no, what is that? Where does that come from? Well, that's in K. And that's going to be down here as far as oops, should be right here. HIJ. Oh no, it should be down here. Sorry. Okay, this 2377 is right here. This is adjustments was paid by seller in advance because HOA dues got to be paid. and or were paid already, and county taxes get prorated, right? So these are our fees that have to be paid, because again, the seller had paid the HOA dues for April. Our client is responsible for the dues from April 10th to the end of the month, which is a prorated amount of $325.50. So, um, and I put this line down the middle here because it shows this side is seller side. This is only buyer side that we're going to look at. Scrolling down, you can see here what the client has already paid. They got a deposit of 27. They got a loan of 765. They got a seller credit of 5 grand. And then down here it does the calculations, right? It does the total due minus already paid equals the remaining money due from borrower. Cash to close from borrower 127, 229, which we're hoping adds up to this. So there you go. That gives you the whole breakdown of the document, right? If you have questions, if you're not sure, or if you have an estimate you want us to take a look at, you're like, hey, these fees don't match what you just said, Joe, reach out to me. You can find me on Instagram at the Joe Soto. You can email me at Joe at the Soto Team. I'd be more than happy. Just put YouTube um, closing disclosure video, and I will make sure that I know what you're referencing so that way we can try to help you out. But I hope this is helpful. If you want to see more stuff like this, let me know. I can walk you through some more of these disclosures because I know it's a lot and we want to make it easy for you to be able to understand the mortgage process. So thank you so much, and I appreciate your time.